everyone. It's Brad Thomas and Nicholas Ward. Welcome back to the wide-moat show. Episode number 3 today. Nick, it's good to see you.
Yeah, no, it's starting to feel real here. Episode 3, our third topic, and I think this is a pretty big one for us.
It is. So today we're going to explore, we talked about it last week, gave everybody a heads up. Today we're going to talk about the magic of compounding. Now, before we get into that, before we get into kind of more of a financial application, I want to talk about a real application in my life. About 10 years ago, Nick, you're aware of this, I decided to get really serious about my health and wellness. I felt like I was, becoming a little overweight, and my teeth were starting to get a little crowded, and I needed some transformation in my life. I'd gone on TV quite a bit during that time because I had just published my first book, and I was trying to get some promotional marketing for my book. And I looked at these videos, and I thought, man, I need to lose some weight, and I need to get my teeth fixed. And so what's interesting is I went to an orthodontist. I had, a couple of kids I'd already paid braces for. And I went to the orthodontist and said, hey, man, I don't need all this expensive gear. I just need to get my teeth fixed. And so he literally slapped some braces on my lower teeth. And what I noticed was over the weeks and weeks and months that went by is the teeth were starting to get straight. I started to lose weight. And I noticed that because I had these braces on my teeth, I wasn't eating as many muffins and I wasn't eating as much junk. And simply I was transforming my life to become a healthier person. I went to the gym a lot, and I went to the gym today. It's interesting to see the transformation that can take place when you have repetition time and time again, like what happened with my exercise habits and, of course, getting my teeth straight.
Yeah, no, and just congratulations there. I am scared to death of braces. My 5-year-old was just at the dentist, and apparently her teeth are too close together. So they look good to me, but the dentist said, hey, we may be in a store for some orthodontics stuff in the future. So not looking forward to that. But I guess transitioning to today's topic, and the beautiful thing about what Brad's getting at is compound, the power of compounding. That's what we're going to be talking about today. He made positive changes in his life that have improved his quality of life and the way he feels about himself. The issue with that is you do kind of hit diminishing returns, right? Your teeth can only get so straight. Your muscles can only get so big. I had kids. We started this company a couple of years ago. I was on my couch. I gained 20 pounds, kind of, I guess, similar situation than you. I started lifting recently, and, from a baseline, I think I went from 275 to 350 on the bench pretty quickly, but I've been stuck there for months, right? So, and I think that's just where I'm at. I can't be much stronger than that without steroids or something. Not going to do that. But that doesn't happen in the stock market. And that's why we love the power of compounding so much. And that's what we want to talk about today. Human bodies have limits. As far as we can tell, looking at hundreds of years of U.S. stock market data, the S&P 500 doesn't. It just keeps going up and up and up. Obviously, there's down years. But, it's a very, very powerful thing that we want.
Yeah, Nick, I think the best analogy that I tell people when it relates to compounding is the snowball effect. And you can imagine pushing a snowball down the hill, continuously gaining more snow as it travels, reaching the bottom, and you got this big, massive snowball at the end of the mountain. And that's snowball compounds during the travel. So that's what this is all about. The snowball effect explains how your actions carried out over time can lead to significant results. Nick, one of the most famous quotes, now we can debate who said this or not. Of course, I'm referring to Albert Einstein, who once said, mankind's greatest invention was the compounding of interest.
Yeah, now, allegedly. But
allegedly.
Funny. And please, if anybody can send me, Brad and I talk about this a lot. I love that quote. Compound interest is the most powerful force in the universe. I've read a lot of Einstein's work. I can't find him ever having said or written that. If he has, please send it to me because I would love to be able to use that quote. I hate not using it if I can't source it.
Well, the only thing I can do to validate is I know Einstein, he passed away with a net worth of $400,000, and that's $1.8 million a day. So he must have known something about money and finance. But another another legendary American, of course, Benjamin Franklin said, money makes money, and the money that money makes money. Now, that's probably the simplest definition you can find of the power of compounding.
Yeah, no, that I do love that quote, and I actually hadn't heard that before. Brad prepped with this video for me, and it resonates with me a lot. My kids ask me, Dad, what do you do? What do you, we got CNBC on. My daughter knows that a green chart's good, a red chart's bad. She's also knows that when the chart's red, that's when we should buy. So maybe I'm most proud of that. She's like, hey, it's down, we buy more. I was like, exactly right, honey, that's a good job. But I tell them, what do I do? I make money grow. So Benjamin Franklin and I have kind of the same idea. And like you said, the money that grows keeps growing. It's wonderful. Throughout this video, we'll put up some charts to kind of show this. It's easy to talk about it, but when you see it and when you see, I think bar charts, really just a simple bar chart showing compound interest over time, kind of speaks volumes and will allow you to sleep well at night and will allow you to kind of stay calm and even have peace of mind during market downturns. And then I guess, I recently wrote an article at wide-moat called something like the 2 lies that will make you rich. One of them was that Einstein quote. Not that it's a lie, but just saying, I don't think he ever said it. Another interesting quote, and you hear people on CNBC all the time talk about this famous Fidelity study that happened. I think they say it happened in 2013. It looked at like 10 or 20 years of data, and it said, they looked at all their accounts. Fidelity is one of the largest asset managers in the world, and they said, who are our best performing investors, and what do they do? What sets them apart from the other people? Allegedly, their study says it's either people that 1, forgot their password, or 2, were deceased. And what's the commonality between those 2 things? They weren't trading. They were simply holding what they owned. And those are the people that outperformed everybody else, because when you hold what you own, when you hold wonderful compounders, you generate wealth. Once again, I don't think that study is real. I've looked for it, and I've even read articles where people contacted Fidelity and they said they never performed that study. So it doesn't take away from the story, though. Even if the study is not real, it should be. And I love the story that just don't trade. And it reminds me. I know, Brad, you're really good friends with Chuck Carnival. We put up fast graphs a lot on this show. We both worked with Chuck before. I remember him saying this many times. He says a portfolio is like a bar of soap. The more you touch it, the smaller it gets. And by touching it, he means trading, right? So we don't want to do that. We just want to own high quality companies. And that's what, we will prove to you guys in this compounding episode.
Yeah, Nick. And I think it's important to also talk about a little bit the rule of 72. This is certainly applicable to our discussion. So the rule of 72 is very simple. You divide 72 by the percentage interest that you want to obtain, and that result is the number of years that it would take for you to double your money. So in this case, you divide 72 by 10, if that's the interest rate that you're talking about, it takes 7.2 years for you to double your investment by that time. And I think that's a critical thing to understand in terms of the time value of money, because obviously we talk about this a lot. In fact, next week we're going to be talking about sucker yields. I'll go ahead and give you some fair warning. So when you have returns that are higher than 10, 11, 12%, when you get to that 15 and 20% range, sometimes that's too good to be true. And there's I don't know of anybody who can really accurately, consistently double their money each and every year. That's virtually impossible.
Yeah, no, that can't happen. I mean, you hear about things. I've had stocks, I think Palantir was up 100% last year for me. That's wonderful. But I certainly don't count on that every year in, year out. But I think the rule of 72, it is anybody can do this. It's very simple, right? And when Brad says interest rate, you can think about it from total returns, capital gains, if you don't have dividends or bonds. All that matters is your rate of return. Like Brad said, you divide that by 72, and that's how many years it takes to double your money. The S&P is up over the long term about 10% a year. That's, I think, like its 50-year average up and down. I think 9.8 something. So like Brett said, you're doubling every 7.2-ish years. That might not seem exciting to some people. I know a lot of people want to hit home runs. You double it every 7.2. That means you're quadrupling every roughly 15. That means every 30 years. I know 30 years is a long time for people to like look down the road here, but that means, if I'm doing my math here, I think you're times 16 on your money, right? That's significant, and that's with no contribution. So obviously, if you're adding money to your savings over time, it's growing even faster than that. But yeah, with regard to the home run, I think Brad does have a wonderful story to tell here. I think hopefully we can get a video on the screen for you guys to see what's going on. And this, I think, I think it might hit a little close to home to Brad, and it's kind of a sad story, but it can be happy for you guys. So let's get into this.
You bet. Well, Nick, you talked about starting early. So my son, he's during college, he just graduated, but about 2 years ago during COVID or coming out of COVID, he was doing a lot of gaming. And by the way, Nick's a great crypto analyst, really good. He's an analyst, and he writes on Seeking Alpha now, of all places. And so he was gaming. And one Sunday morning, I go into his bedroom, and it was unusual for him to be up at 9 a.m. And I said, Nick, what are you up so early for? And he said, well, I stayed up all night. He said, you're not going to believe this. And I'm going to put this video up on the screen. This is a video of my son after he had gamed with his friends. He won close to $70,000 gaming. And again, you can see the screen kind of exactly what unfolded. And so I told him, I said, Nick, all right, here's what I'm going to do.
Brad's son's name is Nick as well, by the way, just to avoid confusion. There's a lot of Nick.
Nicholas. He likes to be called Nicholas anyway. So I'm sorry, Nicholas. Okay. So Nicholas, I said, let me tell you what you should do. I'm going to give you my advice. You should divide this money up into 3 different buckets. Bucket number 1 is Uncle Sam. You're going to have to pay some taxes. So take about 1/3 or 25% or whatever, something adequate into your bucket so you can pay some taxes. I had to explain to him how that worked. Secondly, here's the other bucket is dividends. Let's go build a dividend basket. We went to Charles Schwab and we bought Johnson & Johnson and, Realty Income and a lot of companies that had long-term dividend records. And I know we're going to be talking about some of those names here shortly. And the third bucket, I said, Nick, you like crypto, man, go for it. I mean, that's your speculative bucket. Well, it took about a month, maybe 2. And that third bucket had vanished. That went to 0.
Not surprised to hear that, but that's okay.
Yeah. And again, he had to learn that lesson sometime. We've all learned it, by the way, haven't we? I've got my own stories of how I lost a lot of money gambling, not physically gambling, but just stupid decisions in investing. And a couple of months later, I went back and I said, Nick, how's that second bucket coming? How are these accounts? And he looked at me kind of astonished and he said, Dad, there's nothing left. So he basically took that second bucket and gambled. So
and there's nothing left, not because Johnson & Johnson went to 0, because he went ahead and said, I'm going to go ahead and take that out of my brokerage account.
Exactly. And of course, the third bucket, he had the IRS bucket. Now, he was able, I want to give him some credit. He was able to use some of that money and buy a car and still pay his taxes. He had some expenses, some tax losses he was able to use. So at any rate, that was my story of my son, but it was gambling. And I wish he had learned the rule of 72. And to your point, Nick, if you start early in life, it's amazing to see the power of compounding go to work here.
Yeah, I mean, he's sitting on about $100,000 now. He just got that 10% annualized return over the last few years.
Well, especially if he were utilizing what we refer to as drip investing. Now, drip investing, for those of you who aren't familiar, that's dividend reinvestment plans. And this is one of the most disciplined ways to accumulate wealth. You basically take those dividends and they go right back in to the shares that you purchase. It's like a free ATM machine. It's a way to go back in and reinvest in these companies, utilizing this dollar cost averaging, which is buying shares if they're cheaper. I want to give an example of how Realty Income, how this works, and I'm going to use Realty Income as an example. This is one of my companies I want to talk about today. Now, we did talk about Realty Income in episode 1. And you might recall that we talked about moats in episode 1 and different moat advantages. Now, Realty Income has a first mover advantage. So they have the scale advantage, 15,000 plus properties in 50 states in Europe and 1,500 different clients. So well diversified. This allows the company to mitigate risks associated with consumer trends and economic slowdowns and geopolitical volatility. And we're seeing a lot of that today. By the way, shares of Realty Income are up today. No surprise, because the NASDAQ's all over the place. Now, the company has portfolio occupancy of 98.7% with a weighted average lease term of 9.3 years. What I'm trying to tell you, this is a very stable and predictable business model. The second moat advantage, and also mentioned this in episode 1, is the cost of capital. A-rated balance sheet with both S&P and Moody's, which is just an elite number of REITs that have that type of A-rated status. Very healthy balance sheet, which allows them to have optimal financial flexibility to take advantage of new acquisitions and grow. Now, in terms of growth, again, this company has increased their dividend for 30 years in a row. So it makes them a dividend aristocrat, moving closer to a dividend kings. By the way, my next pick is closer to a dividend kings as well. Now, let's talk about the power of compounding, how it works for Realty Income. Just suppose you own 300 shares in Realty Income today, valued at, say, $17,000. So the annual dividends you would expect are around $1,000. However, Realty Income pays monthly dividends, so you get about $80 per month in dividends. So by dripping, that's directly reinvesting, you buy 1.5 shares. But if the stock drops to, say, $40 a share, I don't think it's going to do that, but let's say it drops to $40 a share, that same $80 in dividends gets you 2 shares. Now that's how this dividend reinvestment program works. It's a built-in compounding that can increase the size of your portfolio over the years or decades going forward.
Your share count goes up, and like Ben Franklin said, right, all those new shares they're paying dividends too. So it's like you're just creating new, they're real. It's real money. You're just creating new dividends out of fresh air, basically by just having this drip system turned on.
Absolutely. Sustainable investing is about playing the long game. And people always don't understand this. Now, I'm going to put a chart up here. You can see Realty Income, what happened to a $100 investment since 1994, and compare that to all the other indexes. Now, the second company I want to talk about, and many companies, by the way, have direct reinvestments. Johnson & Johnson, Coca-Cola, Procter & Gamble, and of course, my next pick.
And for what it's worth, guys, also, I'm pretty sure most well-known brokerage accounts, you can turn this on, right? So the companies offer it directly, like Brad says. I think some even offer you a little discount. But Schwab, Merrill Lynch, Fidelity, all these companies offer you dividend reinvestment. So you can turn that on and just kind of set it and forget it.
It's automatic. It's automatic discipline. So the next company I want to talk about, by the way, this company, it's about as boring of a company as you'll ever imagine. It's like watching paint dry. Oh, by the way, I'm talking about Sherwin-Williams. This is the paint company. So Sherwin-Williams, their track record is 46 years in a row of dividend increases. So again, almost a dividend king, just 4 years away. Dividend king, of course, is 50 years in a row. Company was founded in 1866, and their first dividend payment was in 1885. They're in 120 countries and went public in 1925. Now, the impressive thing to understand about Sherwin-Williams is that they have a very predictable dividend growth history. As I mentioned, they just increased it here in March to at 10.5% dividend increase this year. And that's pretty consistent. Over the last 5 years, their average dividend growth has been around 14% or so. So, Nick, how does the power of compounding work with Sherwin-Williams?
Yeah, I think this is a good example because you look at Sherwin-Williams stock and you see the dividend yield's like 0.9%. It's less than 1%. So a lot of people look at this company and say they must not be very generous. They must not be returning cash to shareholders. Why would I own such a low yielding stock? Yada, yada, yada. I hear people or I see them like turn their noses up at low yielding stocks all the time, but they're missing kind of the forest for the trees, so to speak, because this company, sorry, I'm looking at data here. I want to get it right. Like Brad said, they've been growing that dividend, 10 to 15% a year for a very long time. So how do you have a less than 1% yield with 15% annual growth? The answer is your share price is going up at a rapid rate, right? Why is that happening? Because the fundamentals that support that dividend growth are rising. And when fundamentals rise, share price follows. Maybe not in a direct relationship, but over the long term, that always happens. So Sherwin-Williams is selling more paint. They're taking market share. They're innovating. They're raising margins. You have to paint your house when you sell it. You have to paint your house every 20 years on the exterior, or it's going to rot and you're going to lose, the biggest investment you ever make. So they've been compounding. And so, yeah, I wanted to look at this. I got some numbers here. If you just bought the S&P 500 20 years ago, you would have got 9.8% annualized rate of return. That's great. You're turning $1,000 into almost $7,000. That's wonderful. But a company like Sherwin-Williams, which is a great compounder, that same $1,000 turned into $30,000. That's why the dividend yield is so low, because the stock has outperformed the S&P by such a wide margin. I'm looking at a fast graph here. We can throw this up on the screen. You can see this company's only produced negative earnings growth 3 times in the last 20 years. And all 3 times are on the tail end of recessions. It's 2008, 2009, and then also 2021 coming off of COVID. So basically, unless out in any sort of normal economic environment, this company has found a way to grow. Analysts are calling for 6% growth this year, 13% growth the year after that, 15% the year after that. The growth's not going to stop. People are always going to need paints and coatings and things like this. So yeah, the dividend yield's low, but the snowball is crazy. 20 years ago, the dividend was 25 cents a share. Today, it's this year, it's going to be like $3.20 a share, right? So that's massive. That may not sound like much, but when you look at it, it is. And that's why this company has, just made a lot of people a lot of money.
Yeah, Nick, you're right. I mean, shares have fallen off a little bit. They're still not what I would call cheap today. One other way that I like to play Sherwin-Williams, though, I was a developer and I built stores for Sherwin-Williams in the past. And one of the companies we cover, Agree Realty, ticker ADC, they own a significant number of Sherwin-Williams stores. So this company has a very reliable tenant in their portfolio that generates, over $12 million a year in revenue for Agree Realty. So that's another way to play this company if you're not going to buy it today and waiting on a little bit of a bigger pullback.
Yeah, I agree. I mean, looking at the fast graphs, you'll see the stock price is elevated above long-term averages. It has come down. I'm surprised it's come down because Trump's kind of drill baby drill prices driving oil down is going to increase the margins for Sherwin-Williams. Guess what? They're oil-based paints, a lot of these things. So costs of their input costs are falling. Profits are going to rise. I think that's why analysts are so bullish on the company moving forward. And this company, the chart looks pretty similar to several that I'm going to talk about in a minute. But before I get to those, I do want to kind of pivot. Brad kind of gave that sad story about his son, winning all that money and then ultimately losing most of it. And, we've all made those mistakes and hopefully we don't make any. But there are some examples. And why do we do that? We do it because we're greedy and we want to hit the home run. Brad talked about the home run. We're not patient. And you kind of think, hey, it can't happen. You can't buy boring stocks and get rich. So I just want to give some examples. Maybe you guys have heard of these people. If you Google them, these are kind of famous examples, but they're worth hearing of just normal, everyday people that have gotten exceedingly rich doing exactly what Brad and I are telling you to do. So I'm going to look down. I got to read. I want to get this stuff right. There's a guy named Ronald Reed. He, at the end of his life, he's just a normal guy, right? He was in the Army. Then he was a janitor at like J.C. Penney. Walked around town, drove a Toyota Camry. He said that his lawyer, when he died, said one of the only things he indulgences that he allowed himself to have, he'd go down and get a cup of coffee at the diner. Well, apparently he looked so disheveled that like multiple times people bought him that coffee. Like they felt sorry for him. And then they said some of his neighbors would like knit him hats and stuff because he looked poor. Well, when he died, lo and behold, he donated $6 million to the local library that he went and got books at his whole life. And people wonder, how did this happen? Well, it happened because he was living below his means his entire life. He's on a janitor salary, right? And maybe some military benefits, but not a lot of money. He lived below his means. He invested that money. A Motley Fool article said he owned companies like CVS and John Deere. And then I've also read that he owned like Procter & Gamble, JP Morgan, General Electric, Dow Chemical, J.M. Smucker, Johnson & Johnson, which you mentioned for your son. These are all very boring companies. However, just slowly compounding them throughout Ronald's life allowed him to make that massive donation. And he is a hero now in Brattleboro, Massachusetts. There's another guy, Edward Avedizian. Sorry if I mispronounced that. He donated $100 million to the Boston Medical School when he died. He was a clarinet player. He played in the Boston Ballet Orchestra. I don't know. I'm pretty sure clarinetists don't get paid that much. Maybe I just took the wrong profession. Maybe I should be playing the clarinet. But basically, he said, I know he didn't make a lot of money. When he traveled around to these orchestras, he'd always be reading stock stuff. And he just bought wonderful companies. There's another one. I'm going to be quick here, but these are great stories. Sylvia Bloom. She was a child of immigrants during the Great Recession. And she was a secretary in New York. So she put herself into college. She went to secretary. Every time she heard what her bosses were buying in the stock market, she would take her little bit of savings and just buy the same things. And lo and behold, on her death, she had $8.2 million and she was able to donate $6.2 to charity. once again, surprised everybody. They're thinking this is this old lady. She's a secretary. How did this happen? And I think maybe the most incredible one is Grace Groner. Her story circulates a lot. She grew up poor. Her parents died when she was young. She was like an orphan, put herself through college, worked for Merck, the pharmaceutical company. Actually, sorry, Abbott Labs, excuse me. She worked for Abbott Laboratories. She got 3 shares of stock, I think, back in like the 40s or something. When she died, she donated $7 million to the small college that she attended because those 3 shares had turned into $7 million. So they split, Lord knows how many times. They've been growing that dividend. Merck's paid a dividend for 50 years. Sorry, I keep saying Merck, Abbott, excuse me. I think Abbott has paid that dividend for more than 400 quarters now, and I think she got most of those dividends. So she was another lady that just out of the nowhere was able to donate all this money. And how would she do this? Just buying a wonderful company like Abbott Labs. It's split into AbbVie, and then it's a wonderful thing. So Brad mentioned Sherwin-Williams and Realty Income, and I want to mention some things too. We want all these episodes to be actionable. So these are the types of companies that I think could turn somebody investing now into the next Ronald Reed or into the next Grace Groner. And one of them is MasterCard. And Brad's written a lot about this. This was his number 1 growth stock for wide-moat. We own this in our portfolio. It's done great. MasterCard went public, I think, in like 2005, and it's posted double-digit EPS growth during every single year since then, except for the COVID year. Obviously, that's like a once-in-a-lifetime thing. I don't expect another 100-year pandemic to happen. But just like Sherwin-Williams, this company's been growing like a weed. I'll put up a chart here. Once again, very low dividend yield, but it's the same story. It's growing that dividend at 15% plus a year. So don't look at the 0.56% dividend yield here. Look at the growth. One penny dividend in 2006. In 2025, it's going to be north of $3 a share. So, I mean, that is incredible. And it's still growing at 15% a year. So, you divide 72 by 15, 4.8 years. You're doubling that dividend in 4.8 years. So in 5 years, you're talking a $6 dividend. In 10 years, you're talking a $12 dividend. That is how you get rich. MasterCard is one of our favorite companies in that regard. I'm going to be quick here, but another 2 of my favorites are, one of them is Booking Holdings. I don't know, Brad, if you've gone on vacation recently, but you've probably, if you have, there's a decent chance you booked your hotel, your travel, all that on Booking. They have posted, same thing, I'll throw the fast crop up, double-digit growth almost every single year in the last 20 years, except for COVID. Obviously, we weren't even allowed to travel during 2020, so it's certainly not their fault. That's a one-off thing. Earnings plummeted. They're way back up now. They just started paying a dividend last year. So unlike an AbbVie or an Abbott or a Merck or Johnson & Johnson, any of these companies have been doing it for 50 years. They're just starting their dividend journey now. But if you look at their profits, I think they have what it takes to be a dividend aristocrat in 25 years. We'll throw up the fast graph. This one actually looks attractive now. It's 24 times. That's right in line with this long-term average. And like Warren Buffett said, he would much rather buy a wonderful company at a fair price than a fair company at a wonderful price. When you buy wonderful compounders like this, you generally make a lot of money. This company's compounding its earnings at 15% a year. The stock price will follow that, as will the dividend. And the last one I want to mention is one that I don't think a lot of people know of, and it's a shame. It's a crying shame. Marsh & McLennan Company, they're an insurance broker. Boring. It's really even hard to understand what they do. They just sell insurance, and they also do consulting for management and stuff like this. If you look at this chart, once again, in the last 20 years, only one negative earnings growth year. That was during 2007, during the Great Recession. They actually grew during COVID, and they're expected to grow roughly 10% a year here. Dividends been growing the whole time. So Marsh & McLennan, they're a little pricey right now. I own shares. I'm not buying them now, but they're a company I'd love to buy on a dip. I'd love to add to my position. And when you just see the steady fundamental growth, the snowball that Brad talked about, these are the types of companies. They're boring. They have relatively low dividend yields, but we're not chasing the yield here. We're chasing the growth. That's what we want. We want the compounding. That's what makes you rich over time. Like we said, if the dividend doubles, triples, quadruples, 10 time X's over the next, couple of decades, you'll be happy that you bought shares today later. I think I'll kind of end my point here. I know I've been talking for a while. Hopefully this has been good. There's that old Chinese proverb that says the best time to plant a tree was 20 years ago, but the second best time is today. Well, the same thing goes with dividend stocks and these growth stocks, right? Obviously, I would have loved to have bought Marsh & McLennan 20 years ago. Maybe I wouldn't be doing this show. I'd probably be retired then. However, I didn't. So the second best time just to do it today and just start that compounding now. And in 20 years, I'll be happy that I did because I'll have this massive dividend tree throwing off fruit. So, Brad, I'm going to rest my vocal cords here and pass it back to you. And then I think we'll wrap up the show and then we'll talk a little bit about next week's episode.
Great. Well, we have 5 great companies here today. By the way, all of those have different wide-moat characteristics, and that's what we do here at wide-moat research is we analyze these companies and determine these competitive advantages that differentiates them from their competitors and that generate these companies. What's the common thread is they generate very consistent, reliable dividends. Now, I'm going to recap really a couple of what I call best practices when it comes to power of compounding. First of all, we mentioned this time and time and time on this show. You got to start early, just like my son who's in his early 20s. The earlier you start, the more dramatic you're going to see an impact on with your portfolio. The second attribute is you should have regular contributions. Stay consistent, just like going to the gym, just like eating right. You've got to be disciplined and stay consistent with this program. The third thing you want to do is scale up your investments. Now, as your income grows, your expenses could decrease as well. This is going to allow you to have increased the amount of your contribution. So again, regular contributions and increasing those contributions.
And I'll stop you real quick. And why is that important? Because lifestyle creep happens, right? This is kind of just not stock market advice. This is kind of just financial advice. You get the promotions. You see your colleagues driving, and they're not driving the Toyotas anymore. They're in the Porsches. You see your people get married. They're having kids, getting better houses. You don't. I mean, keeping up with the Joneses is nice, and in some professions you have to do that, right? I understand. You have to have a certain brand on your wrist. You have to have a certain type of shoes on your feet to fit in at a certain part to continue to get promoted. But as best as you can, try to avoid lifestyle creep because it doesn't have to happen. Just because somebody does something else, you don't have to do it. In 10 years, if you had invested the difference of, the Toyota versus the Porsche, et cetera, you'd be able to buy 5 Porsches, right? So just, I didn't mean to interrupt, Brad, but that's lifestyle creep, is a really big issue for people that are saving for retirement. And, just try to always, always, always live below your means and make sure, like Brad said, you're being consistent with your investing.
Yeah. The next thing I think you would stay away from your temptation to dip into your accounts. So again, this goes part of that discipline strategy. Another thing you should consider is when you have these windfalls, when you have bonuses or refunds, or maybe you win the lottery, or like my son, you win this gaming thing, you've got to avoid the temptation to spend it. And the last thing, and this actually leads into what we're going to be talking about next week, is you do want to increase your rate, but beware of sucker yields. And again, next week, we're going to talk about what a sucker yield is and why you want to be careful with certain rates when they get too high and they're too good to be true from time to time. Now, we're done with this. I want to also mention every week we give away a book. And here it is, Reach for Dummies. This book I published last year. We sent out several copies thus far. Also, Ronnie Johnston, if you watched last week, please look for me on Twitter or Seeking Alpha. And if you'd send me a message there, I will ship you a copy of the book from last week. And we're looking for you to comment below here in our video. And we're going to send the book out this week to anybody who comments first on our chat below the article here.
Yeah, so if you want to get the books, comment. Also, just please like the video, subscribe to our channel. We'd love that. Like Brad said, episode 3, we're very excited. It's growing. I think we're up over 1,000 subscribers, and it didn't take very long. So that's, thank you so much. That's awesome. Let's get to 5,000, maybe 10,000. We'll give another giveaway. We'll do something cool. So please like and subscribe to the channel. And like Brad said, next week we're talking about sucker yields. I know this week we kind of highlighted lower yielding companies. We love high yielding investments. Don't get us wrong. Really Income has a 5.5% yield, I think. We own a lot of high yielding companies in our portfolios, but what we never want to do is chase yield and buy one of those unsustainable yields. We always want the dividend to grow. That's how it compounds, right? Compounding happens when you reinvest, but if it grows organically, that's just rocket fuel to the compounding process. So we want to make sure that you guys aren't chasing those yields, that you understand how to identify a company with a safe dividend yield and how to identify ones that are at risk of cutting that dividend. So that's what we'll talk about next week.
Yeah, and in fact, next week, Nick, I'll mention we actually have telegraphed our readers in advance multiple times of companies that we thought were dangerous and could, in fact, cut their dividends. And we'll show you exactly if you would have avoided those companies like we recommended, how you would have saved your money and protected your principal. And that's really the key for us, is not about chasing yield and doubling our money in a year. It's about sleeping well at night. We call that Swan investing here at wide-moat. So I want to thank everybody for watching this episode number 3. Look forward to seeing you back next week for episode number 4. And thank you all. Happy Swan investing.
Yeah, happy Swan investing. See you guys.